This week, we have been focused on the most exciting names in real estate with our series, Property Players. And who more exciting than William Macklowe? He's the founder and CEO of William Macklowe Co, who broke away from his family's firm last year after all those years of turmoil during the crisis where his family had to sell the GM building. But that is all in the past. I know Billy wants to look into the future. He's just made his first property deal at his new company. Billy, great to have you back with us.
Thank you very much, Betty. Great to be here.
Trudging through the snow.
Wasn't that
okay,
bad.
Let's talk about this new property, 636 6th Avenue, right, in
Yes.
Chelsea. What did it take to get this deal done?
Well, right now, there's a great froth in the investment sales market in New York. So I think it was a question of being able to execute on diligence, have a great partner, have the capital commitment, and demonstrate that we had the ability to perform. And we demonstrated that to the sales broker and to the seller, so we're very excited.
Right, you partner with ING Clarion.
ING Clarion.
Did you work with them before?
We've known each other. We've looked at deals before. This is our first time joining hands, and I think we're very excited. For us, it's a great event to have this partnership, and I think they see in us the ability to realize on the value.
Okay. Well, you bought it for $45.2 million. That's 50% more than where I think the previous owners had bought it, though. I mean, what does that tell you?
That we paid 50% more than the previous seller, or the previous owner. We don't really look at what a purchaser paid for a property is selling it. We don't look at an investment as why is somebody selling, why is somebody buying. Right. We're interested in why we're buying.
But doesn't it? But what I'm saying, what I mean by that is that was bidding fierce. Was it? Was there a lot of competition? There
was a lot of competition. My understanding was they had over 115 signed confidentiality agreements in the sales process, and there were 20 credible and qualified bidders coming down the stretch.
You among them. This is an all-cash deal.
Yes.
Okay, why'd you go all cash?
We wanted to take control of the property, put in place our plan for the repositioning effort, and then seek to tap the capital markets at the appropriate juncture when we feel it's right.
And that's the right deal, right way to go. Okay. This building, though, itself, I think it's 6 stories.
Yes.
Right. It's over a century old along those lines. And we were talking to Tony Malkin yesterday, who said effectively that smaller properties and smaller blocks of space are going to do better in this environment than large, big, new blocks of space. Is that something you agree with him on?
I do agree with Tony on that point. I think if you really look at Manhattan leasing velocity on a historical basis, over 70% of transactions that occur are less than about 25,000 square feet. This property in particular, with a 13,000 square foot floor plate and a corner location, should really appeal to that more boutique user. And we think it does open up sort of the breadth of who we can appeal to.
So who are the renters? Who are you targeting?
Well, we'll target who has the best credit, who will pay the highest rent.
Right.
No, I mean, a landlord's dream,
pay their rent, right?
No, I think, it's, while this isn't a Plaza District or financial type of building, it is in the heart of a very critical part of Manhattan now, as evidenced by the Google transaction.
Right, and, which is that building right near you.
Exactly, and we think that will put a lot of tenant demand in that market. We think it's a great commitment to New York in terms of the intellectual capital of New York, where New York historically has been known as a financial community, never really a tech town. This is a dynamic sea change, and I think Google also will continue its initiation of a space aggregation program at 111 8th, and that will also put further pricing pressure into this submarket. And that should allow us to really achieve our rental expansion goals at the property.
Wait, so that they might experience pricing pressure?
They will create pricing pressure in the market.
They'll create pricing pressure.
Google
okay.
just bought a
huge building.
3 million square foot building. They didn't buy it for the investment of collecting rent. They bought it for the investment in themselves.
Right.
So as they can get to space, they will take space. If they can get a foot, they'll take a foot. If they can get 100,000 square feet, they'll take 100,000 square feet. That will push occupancy and tenant demands in this submarket. The Chelsea, Flatiron, kind of Midtown South submarket right now is really enjoying one of the highest occupancy statistics citywide. And I think this will further those numbers, and that should translate to higher rents.
So for you, then that means this is a great time for you to keep buying then.
We're very excited. We want to keep buying. We want to buy on a measured and controlled growth. We are very.
And you're only looking in New York, though, right?
We have a view of looking nationally. We'd like to chase opportunities that fit our profile. And now we're starting to see a lot more momentum in Manhattan, which obviously is our core market and our backyard.
Okay, where nationally would you say, if you were going to step outside, where would you first go?
Well, from an office perspective, certainly Washington, D.C. If we're looking at residential assets, I think there are a lot of prime markets that we would we would invest in.
Okay, and as Tony was saying yesterday, those are sort of the Cinderella cities right now. Let me just run for you a soundbite from what Tony was saying about financing. I want to get your reaction to that.
Well, the loan to values may be lower in the 60 to 65% range. There's a lot more available, and there's a lot more mezzanine available, a lot more subordinate financing that bridges the gap. And there are a lot of transactions being done today with a lot of equity being deployed by new players.
And the new players among them being the private equity groups as well as, I mean, is that something that you're seeing as well?
I think we are. We're definitely seeing that. We're seeing a lot of liquidity opening up on the balance sheet side, certainly with pension funds and life companies, but now you're starting to see the resurgence of the CMBS markets. And you're seeing sort of a new entrance into that space, and a lot of firms that shut down, the Wall Street houses that shut down their CMBS groups are now resuscitating them. And I think we're probably, the prognostications this year are for anywhere from $35 to $50 billion of issuance.
Of issuance, okay.
Yeah.
And is that why, for commercial property, you just haven't seen all those foreclosures that everyone was talking about last year that are going to happen?
Now, I think, low interest rates, again, I think when we last spoke, when I joined you on your show, low interest rates have really kept a lot of people in the game. Because properties, for the most part, are performing fairly well, and they're servicing the debt. So at this point, until there's really sort of a demonstrative move in rates, don't really see that distress happening in core markets.
Yeah, that's going to stay status quo, basically. Billy, good to see you again.
Thanks for having me, Betty.
Billy Macklowe of William Macklowe Company just bought his first building.